Hey everybody, I want to give an overview of account receivable. I received a question on this and I wanted to kind of just help provide a supplemental video that explains an account receivable. So to do this, let's imagine a transaction between two parties, okay, or two companies. On one side, we have a paper supplier, a paper company that sells paper, okay? I'm going to call it Dunder Mifflin. I'm going to steal the example from that show, The Office, because it's a good example here to illustrate this concept. So this is an office where they will basically help get paper to people who need paper, okay? So they literally will sell paper. And what you want to imagine here is a company or a client like a law firm. So this isn't a client that needs maybe one ream of paper at a time. They might need 50 reams, okay, delivered monthly. So they need delivery, right, through a delivery truck. And they want to have it delivered in a regular, recurring basis, okay? So that's sort of the example here. Paper supplier and a customer who needs paper in large quantities. So these two parties, and all I mean by party is these two businesses, they come to an arrangement, okay? They have accounts with each other. Dunder Mifflin agrees to sell the law firm paper. The law firm agrees to sell or to pay Dunder Mifflin for the paper, okay? So very basic sort of arrangement in place. They agree that Dunder Mifflin, when they deliver the paper, will later pay for the paper, okay? So payment here is not going to happen upon delivery, and that's a key concept. So let's look at the dates. May 1st, the paper gets delivered to the law firm, and let's say it's $1,000 worth of paper, okay? And you need to imagine here, the delivery person, just for sake of like imagination, imagine like the delivery person going into the office, having maybe 50 reams of paper, dropping it off near the stock room or maybe in the stock room, and then having maybe an administrative assistant or some other professional office manager sign a receipt saying, yes, we've received delivery of the paper, okay? The office manager then keeps a copy of that. The delivery person keeps a copy of that. They both are aware that the paper has been delivered, and they agree in their signatures attesting to that. And then the delivery person goes back to the warehouse, okay, goes back to where he works or she works. Okay, at that point, Dunder Mifflin has sold paper. They have earned the revenue, okay? So we have to come over here on May 1st and say that revenue for Dunder Mifflin has gone up by $1,000. Because they've done what they're in the business of doing. They have provided paper to their customer. But what hasn't happened is they've not yet received the cash, right? So they cannot say over here plus 1,000 cash. They can't because the delivery person didn't accept cash and didn't accept a check. Instead, what's going to happen, and we'll get to this in a moment, the law firm's going to send a check in the mail, okay, to Dunder Mifflin in a couple weeks, and that's when the cash will arrive. But we need to account for this transaction on May 1st because that's when the revenue is actually earned. So what we're going to do is we're going to set up an account receivable. And again, this is Dunder Mifflin doing this. They're going to show that they have the right to receive $1,000 in payment related to this revenue, okay? So they are due to receive $1,000 in cash, but they haven't received it yet, okay? The account receivable is basically someone who owes us cash, okay? So now let's look at what happens on May 15th, okay? And again, imagine someone in the billing office of the law firm, okay? They're going through their monthly process. They write a check to Dunder Mifflin. They say, okay, I know that $1,000 worth of paper was delivered. I'm going to write a $1,000 check out. They put it into an envelope. Just imagine this. They put a stamp on it, and it goes in the mailbox. And the same day, let's just imagine the same day, it gets to Dunder Mifflin. They open it up, and now they can say that they have cash. So their cash is going to go up by $1,000 because they now have it in hand. Note, they've already earned the revenue. So this May 15th has nothing to do with revenue at this point. It has to do with the cash and the fact that cash that was previously owed to us is now received, okay? So we now have it in hand. So we're going to plus $1,000 of cash, and then what we want to do is we want to subtract out the accounts receivable. We will basically want to bring the account receivable balance down by 1,000. because what we previously were owed, someone owed to us, we've received it, and we've received it through this cash. Okay? This is an account receivable. It happens all the time in business. We're going to see it repeatedly in this course. We're going to see a similar logic in place with an account payable. The only difference is that the account payable is when we owe someone else. So that would be if Dunder Mifflin owed someone else, and we're due to pay them. But in this case, they are the receiver of the cash. They're the ones who earn the revenue, and therefore that's why it's an account receivable in this context. Remember, key terms here with an account receivable or an account payable is on account. So we're going to see this term repeatedly, and we're going to have to analyze the transaction. We're going to have to imagine what is happening so that we can properly interpret the facts and put them into the appropriate accounting context. Okay? I hope this is helpful, and we will repeatedly hit upon this on-account concept throughout the course, so you'll get more time to practice it, but I hope this was a good, at least helpful example for those of you who are still shaky on this concept. Thank you.